Hi, this is Palmer from ForexSwingTrading.com, where our job is educating traders. Today we're going to be talking a little bit about volume spread analysis, also known as VSA. The volume spread analysis is the study of the relationship between price and volume. The reason it's good to study this is because it gives you the underlying structure of the market, and it shows you the natural rhythm of the market. This was developed by a man named Richard Wycoff, who was a famous trader in the 1920s and 30s. And even though the methodology has been around for decades, it has been improved upon, especially by a man named Tom Williams. And it is still really quite useful today, especially in describing the structure of the market. Okay, so what is volume spread analysis? Well, it's not just looking at the volume histograms on your trading platform, but rather it's interpreting the relationship between both volume and price. At its core, it's the study of the supply and demand within the market and the use of the manipulation of these forces of supply and demand. When you begin to understand these laws, you're going to see that the markets are not random, but there are discernible patterns that play out again and again. Okay, so basically, the reason markets turn is when they are in an uptrend, they'll turn downwards because all the buyers have bought and there's no more demand left. Okay, so does that make sense? I hope that makes sense. So in other words, as the market goes up, it'll get to a point where all the buyers have bought. There's no more buyers. There's no more demand. So there's only two things it can do. It can go sideways for a while, or it can go up and then go down. Okay, it can go sideways, then go back up again. Okay, but that's a different story. In a downtrend, a market turns when all the sellers have sold and there's no supply left. Okay, it's a very simple explanation. Now, Wycoff said that there were 4 phases of market. The first phase was called the accumulation phase. This is where the smart money, so the hedge funds, banks, other institutional investors, began buying from the public and other small investors at low prices. Okay, markup is when there is no more supply to purchase and the smart money is long, so the market begins to rise and the price starts to increase. Okay, as the like I said, as the price increases, it'll get to the point where all the buyers have bought. Okay, so as the markets start to rise, this is when you get your breakout traders. This is when you start, getting the what's called dumb money, the retail investors, to start joining in. Okay, a lot of times they'll get in. Sometimes they'll get in early enough, and they'll make some profit. But a lot of times they'll wait too late, and they'll get in at the end of the move. Okay, and that's when the smart money starts to sell their positions, and the dumb money is buying it. And this oftentimes results in volume climaxes. Okay. Once this happens, once all the buyers have bought, once all the buyers have bought, and there's no more demand, the markets will hit kind of a brick wall, and then that's when you start getting distribution. Okay, that's when markets will move sideways for a while, and what's going on here is the smart money is taking profits. Okay, and they're starting to sell the market or short sell the market. Okay, as the smart money does this, the markets are going to start drifting down, and this is called markdown. Okay, so let me give you a chart that shows an example of this. So at the bottom left here, you see accumulation. This is when markets are going sideways. Okay, now this is when the smart money is buying from the retail investors. When there's no more supply left, the markets will start drifting up. Okay. Some of the retail investors will recognize this. They'll jump on board. Sometimes they'll make a profit, sometimes they won't. Okay, sometimes we have a reaccumulation phase, and then we continue to mark up until we have the distribution phase. So the distribution phase, again, is when there's just no more demand. There's no more buyers left in the market, so the market goes sideways for a while. The smart money starts selling the markets. This is called the distribution phase. Okay, and then with no more demand left, the markets will start drifting down. Okay, so and again, the retail investors will start selling this market. Sometimes they'll get in too late. Sometimes they'll get in early enough to make some profit. And then you go back to the accumulation phase. Okay, obviously this is a very, very sort of neat chart. Things don't work this easily. Things aren't always this easy to recognize, but this is sort of the basics of what's going on in the markets. Okay, and when you can learn to recognize this, it'll really make it easier for you to trade. Okay, so a VSA reversal pattern. Basically, once you get into the accumulation phase or the distribution phase, you'll start recognizing volume patterns that happen over and over again. What happens when you'll get into either one of these phases is you'll hit a support or resistance level. In the case of the distribution phase, you're going to get climactic buying into resistance, and then in the accumulation phase, you're going to get climactic selling down into support. Okay. Then you're going to get some type of indication that there's no supply if you're reversing up, or if you're reversing down, you're going to get an indication that there's no demand. Okay. Now there's a lot of different types of bars that will indicate this. Lots of different types of volume bars. There's no demand bars. There's no supply bars. There's stopping volume, absorption volume, shakeouts. There's probably maybe a dozen or half a dozen different ones. Basically, it's just telling you that the market is reversing. Okay, and I'll get into the different types of candles in later videos. Okay, then you're going to get some sort of divergence or candlestick entry. Okay, this is when you get your either price divergence or momentum divergence. Price divergence can come from MACDs or stochastic divergence. I have something called better momentum for volume divergence. With candlesticks, you might get something like a shooting star for a short signal, or a hammer, something like this. Pin bars, inside days, things like this. Okay. So this is an example. This is a 1 hour chart of the Euro Oz dollar. As you can see, you've got first you get these climactic volume. This is the sort of purple circles at the bottom. You get climactic volume. Now it's important to remember not to just reverse your position when you get climactic volume, because usually the markets don't stop there. Sometimes they do, but a lot of times they don't. And also, it can just be profit taking. Okay, so it's not always indicating that the markets are going to reverse, and that's why we wait for a stopping volume signal or some sort of absorption volume or no demand or no supply bar. Okay, and then here, this last one, we get a sell signal. This red dot on the bottom, that's a volume divergence. And then the top one is like a MACD divergence. And then the market doesn't reverse right away, but it does reverse, and you can see it's a pretty big drop. Okay. Now, there are some problems with volume spread analysis. It's certainly not a perfect solution, but it does give you an edge. One of the problems trading Forex with VSA is, Forex really doesn't have any volume. It doesn't have a central volume. The way that S&P futures or stock markets, it has a central exchange. Okay, Forex doesn't have that, so your volume is going to be different for depending on your broker. There's a couple of ways around this. One, you can use Forex futures data rather than the spot market. Then you can use futures data. Okay. Another thing that you can do is you can use different brokers. You want to make sure that these are fairly big brokers that have lots of customers and lots of volume, so they are fairly representative of the market at large. So companies like Alanda, FXCM, Alpari, these are usually pretty good. You can usually get a free demo even if you don't like them as brokers. You can use them as a demo software. The other thing you can do, or the other thing you really should do, is also use a couple of different softwares. So I use something called Smart VSA and Better Indicators, and I use them both on Better Indicators I use on the NT platform, and Smart VSA I use on MT4. They will give you different readings, right? And sometimes they're actually opposite readings. So you need to be careful. You need to only use VSA in the context. You need to use it with things like cycle analysis, and you need to use it with things like technical analysis. And this way you have a few different things telling you the overall structure of the market. So VSA is not something I think you could use by itself. You really need to use it in conjunction with other indicators in a specific context. Okay. Another thing is volume. Like I mentioned, climactic volume in a strong trending market doesn't always indicate a reversal. It could just be profit taking, and so you really do need to use volume with other indicators, and you also need to practice learning to read it. Okay, so my recommendation is to use VSA with trend tools that can show you when a trend is starting to weaken. One of the tools that I use is the ADX. Okay. The advantages of VSA. Okay. Some of the advantages: it can give you an advanced warning of an entry. Okay, so when you see climactic volume, this is when you really want to start paying attention to your charts. Okay, if you read it correctly, VSA a lot of times can get you very close to the top or the bottom of a move. Because it's a multi-step entry method, it keeps you from over trading. Okay, and it increases your level of patience. So because several things have to happen distributed over many bars, this is going to keep you from over trading. Another thing is it increases your confidence in a trade because you're not just looking at technical analysis. You've also got, this is sort of a second non-correlated indicator that's different from price. You're going to get a higher win rate than technical analysis alone, and it's also going to give you a better understanding of what's happening in markets. Another thing I should mention is because it does get you in so close to the top or near the bottom, it can increase your level of profitability. Okay, so it's not only going to increase your percent win, but it's going to increase your pip size, your overall win size. Okay. Anyway, if this has been helpful, I hope this has been helpful, and if you'd like to learn more about predictive indicators, please come visit us at ForexSwingTrading.com. I am going to be posting some volume spread analysis indicators that you can download, so please come visit us at the site and keep watching our videos. Thanks a lot and happy trading. Bye-bye.